Massive amounts of capital are moving toward this single listing at a volume that few other financial events can match. The target is SBI Funds Management. They are India's largest asset management company, currently controlling 15.5% of the country's total mutual fund assets. That scale is built on a joint venture between the State Bank of India and Amundi, combining a massive domestic bank network with global investment expertise. The entry mechanics are specific: a price band of 545 to 574 rupees, and a minimum 26 share lot, requiring a 14,170 rupee investment. Currently, the unofficial gray market premium sits near 19%, reflecting heavy retail demand outside official exchanges. However, high demand often leads to heavy oversubscription. For most retail investors, receiving an allotment is a matter of mathematical probability rather than strategy. Applying for this IPO means tying up capital in a crowded trade where there is no certainty that you will actually receive shares. The structure of this 11,692 crore rupee issue is unique. It is a 100% offer for sale, which means the capital bypasses the company and flows directly to the selling shareholders. Those shareholders are the company's promoters, SBI and Amundi. Because this is an OFS, none of the money raised will be used to fund future growth or internal infrastructure. While promoters cashing out is a common stage in a company's life cycle, it means the IPO capital does not provide any new resources for the business itself. This investment provides exit liquidity for the founders at a market peak, rather than funding a growing business. In terms of absolute numbers, the growth is clear. The company reported a profit after tax of 3,067 crore rupees for the 2026 financial year. This profit volume is a direct result of their pan-India distribution network and their ability to reach millions of individual investors. However, looking at the performance data reveals a specific weakness. While absolute profits are rising, the EBITDA margins, a measure of operating efficiency, have been trending downward. Those margins have dropped from 101% in FY24 to 92.4% in FY26. This makes the company's financial health highly sensitive to the conditions of the Indian capital markets. Their fee-based revenue is tied to the total value of assets they manage. If market indices drop, their fee revenue falls with them, which could put further pressure on those shrinking margins. Absolute profits are significant today, but the declining efficiency suggests the company needs consistent market growth to maintain its current trajectory. At the upper price band of 574 rupees, the company is valued at roughly 38.1 times its earnings. This multiple is close to the industry's most premium player. HDFC Asset Management currently trades at a PE of 41.7. Compared to others in the sector, like UTI Asset Management at 31.5 times earnings, SBI is positioned at a premium price point. A 38 times multiple leaves very little room for management execution errors or market volatility. Paying full fair value at the IPO stage limits potential for future gains through multiple expansion. This asset is priced accurately for its dominant position, which means future returns will likely depend on earnings growth rather than finding a bargain today. The IPO structure includes a specific provision, a 6.41% shareholder quota. To be eligible, an investor must have held shares of the parent company, State Bank of India, on the record date of July 8th. Eligibility changes your mathematical odds, allowing you to submit 2 separate applications. Without it, you face the standard retail lottery, where massive applicant numbers lower your chances. Eligible shareholders apply in both retail and shareholder quotas simultaneously, doubling their allotment probability. This strategy requires more liquidity, as you have to lock up 28,340 rupees to cover both applications during the allotment period. Utilizing the shareholder quota is the most direct way to improve your odds, provided you can commit the additional capital. Your approach depends entirely on your time horizon. You must decide if you are looking for a short-term listing gain or a long-term position. A short-term flipper is looking at the 19% gray market premium, hoping for a profit of roughly 2,800 rupees per lot. That premium is not guaranteed. Broader market sentiment can change quickly, and any volatility before the July 21st listing could reduce or eliminate those gains. For the long-term holder, the ultimate goal is to secure a permanent, unwavering stake in a dominant Indian financial institution. For long-term investors, the risk is missing the allotment and buying on the open market. If it lists at a 20% premium, your entry price is significantly higher. The most effective strategy for eligible shareholders is applying early to secure the IPO price. SBI Funds Management is a dominant player in the Indian market. Success in this IPO ultimately depends on precisely matching your capital lockup strategy with your actual long-term investment goals.